Is life insurance actually a good investment? You probably heard conflicting advice about that. Some say it's a scam, some say it's the best kept secret of the wealthy elite. In this video, we're going to break down the pros and the cons to using life insurance as an investment and how it stacks up against other traditional retirement accounts like 401ks and IRAs. First, I must clearly state that life insurance is not an investment. However, there are certain types of life insurance policies that have the ability to build wealth inside of them that just simply grows over time. Now, to get access to that feature, we're not talking about basic term life insurance. That's pure protection. It expires at some point and it doesn't have any cash value component to it. To get that feature, we're talking about permanent life insurance, such as whole life or IULs that have the ability to grow and build this cash value component inside of them that you can access in the future for anything that you need. Think about it like this. It's part insurance and cash value. You pay more into the policy than the cost to own it. We call it overfunding. And that extra cash is going to grow and compound inside the policy at either a fixed rate or indexed to the stock market with no direct downside market exposure. First, let's talk about the advantages of using cash value life insurance as an investment. First is tax-free growth. One of the biggest advantages of cash value insurance is the fact that the money inside grows tax deferred. And if the policy is properly structured, you can access that money in the future for anything that you need, all tax-free through policy loans. Now, this is similar to a Roth 401k or Roth IRA where those accounts do grow tax-free. You can access them at retirement tax-free. However, with cash value insurance, there is no income restrictions and there are no contribution caps. Second is no market losses. If you're using a whole life policy, that's going to grow your cash fixed somewhere between 5 to 6% per year at the high. If you're using an IUL, your cash value is going to grow indexed to the stock market, something like an S&P 500 or a NASDAQ. So you get to participate when the market does well, your account will grow. But when the market goes down, you lock in your gains and you don't lose any money, unlike you have to deal with a 401k or an IRA. Number 3 is liquidity and access. With your cash value insurance, you don't have to wait until you're 59 and a half years old to touch your money like you do with a 401k or an IRA. You can access your policy's cash value for anything that you need, all tax-free. So whether that's paying for college tuition, maybe buying some real estate, or funding a business, you have access to it. And number 4 is death benefit protection. Unlike traditional investments, life insurance creates an instant legacy for your family when you're gone. While you're alive, the money inside will grow, and then when you die, whatever you didn't use will get added to your death benefit and pay out to your family, all tax-free. And number 5 is no contribution limits. Unlike with 401ks, IRAs, and Roth IRAs that all have contribution limits on what you can put in per year, cash value life insurance doesn't. They're great for large amounts of money to go in terms of overfunding, which makes them great plans for high income earners to own that want to retire or get access to their money, all tax-free. Now, let's be real. Life insurance isn't perfect. It's definitely not for everybody. And there are some downsides that you need to know. First, a lot of the costs are front-loaded. So in the beginning years, a lot of your premium is going to go towards the cost of insurance. Now, depending on how your policy is structured, if it's max funded, you should have full access to all of your cash after 5 years. But if it's not, it could take 7, 10 years, or even longer to see any significant cash value grow. So if you're looking for a get-rich-quick type of product, this isn't it. Second is it requires proper design. If your policy is not properly structured from the beginning, meaning the correct ratio between death benefit and premium, you're going to end up with super low cash value and super high fees. This is why it's so important to sit down with a knowledgeable insurance agent that understands how to properly structure and design these plans to meet IRS guidelines. Third is limits on growth. If you're using a whole life insurance policy, your cash value is growing fixed, somewhere between 5 to 6% per year at most. Now, if you're using an IUL, your cash value is growing indexed to the stock market. And the only way the insurance companies can guarantee you no losses is if they take a piece of your profit in some way, shape, or form. Now, that could be through a spread, a cap, or a fee. And nowadays, a lot of insurance companies offer what's called low volatility indexes, which are just indexes that aren't designed to perform at super high rates. And those a lot of times are uncapped. But the best way to explain it is in exchange for a little bit of your upside, the insurance companies guarantee you no downside risk. Now, over time, this is going to produce more consistent growth results, but still, There are some people that don't want to limit their growth and they're okay with taking on all of the risk in their investment. 4, not all policy loans are free. The only way to get access to the interest that's growing inside your policy tax-free at any time without any penalty is through policy loans. Now, in order for the insurance company to even offer you a loan, by law, they have to charge you an interest rate or it wouldn't be considered a loan. Now, there are some loan types where they actually recredit that interest back into your account at the end of the year. We call that a zero wash loan. And there are some where they don't. So just know if you are paying an interest rate to borrow money out, that interest is growing and compounding inside your account. And if you're not paying your base premium every single year, well, that's going to eat into your cash value. And at some point in the future, it might cause your policy to lapse. However, loans are really important because that is how we get access to our cash value tax-free. And that's not even a feature that's offered to you inside of an IRA or a Roth IRA. And number 5 is there's a little bit of a complex funding schedule. It's not as simple as picking your favorite mutual fund or index fund and tossing a big chunk of cash into it one time and being done. Life insurance policies carry a base cost to it that needs to be covered monthly. And if not, that's going to get deducted from your policy's cash value over time. Now, there's a lot of different ways to fund cash value insurance policies. It could be monthly, it could be yearly, it could be lump sums, it could be front loads. So we really recommend that you meet with your insurance agent at least once a year to review your policy and ensure that you are on track. So when does using cash value life insurance as an investment actually makes sense? When you want stable, long-term, tax-free access to cash, when you're thinking about legacy protection and becoming your own bank, when you've maxed out your Roth IRA or 401k, or if you're a high-income earner looking for tax-free savings. If any of these sound similar to the situation that you're in, it might be time to consider cash value life insurance as your investment. Bottom line is, using cash value life insurance as an investment isn't a scam, but it's also not best for anybody. It works best when it's used for the right reasons and when it's properly designed and structured. If you want to learn more about how to use life insurance as potentially an investment for you, I've linked 2 videos here that will walk you through how it works. Make sure you subscribe so you don't miss another video teaching you different tips and tricks on what to do with your money, and I'll catch you next week on YouTube.